Here we are, folks. Another Tuesday evening. Welcome, welcome. Great to have everybody on. Enjoyed the pre-show chat tonight. A lot of good points made, particularly about who's running the country and have they got any policies, and also the story of landlords who are losing control of their investment properties and all sorts of things that are really quite important. Of course, I've got Damien coming on shortly, and he'll be able to give us the lowdown on what's happened over the last 2 or 3 days. How much is signal? How much is noise? What does it all mean? And should be an interesting conversation. As always, of course, we have the dogs ready to rock as well. Well, when I say ready to rock, they're actually at the moment where they should be. They've had their walks, they've had their lunch, so hopefully they'll be quiet. But as you know, they sometimes get ideas about sitting somewhere else. So they don't always sit in their baskets, but they're there at the moment. And for those interested, here's the studio. I've got Damien ready to come in there. We've got the multi-view, the chat, and everything else running. And everything is streaming appropriately. So it looks as though we're all set up, ready to go. And with that thought, let's get rid of the pre-show. And I'm going to start the show properly. We'll be back in just a moment. Good evening and welcome to this live stream on the 6th of August 2024. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. And this is going to be an important conversation given what's happened in the markets over the last 24 to 48 hours, or perhaps slightly longer now. And we're going to get a read as to what's really happening and what it means, both from an investor perspective and perhaps from a policy perspective as well. We, of course, have the RBA as well, and we'll talk about the RBA rate decision. And, of course, as always, be interested to get your questions and comments as we go. Just before I get Damien to come in, let me just remind you we don't provide specific financial or legal advice. This is a general conversation only. We do moderate the chat, but we encourage you to put your questions and comments in. And if you've got a particular question you'd like to table, if you use @WalkTheWorld, that'll get it into my queue so I see it. And we've also enabled Super Chat, which means that if you want to get your question to the top of the list, you can do that, or indeed make a contribution to what we do around here. It's always greatly appreciated. It helps to cover some of the costs of what we do. We do this not for profit, but because we think there's a really, really important conversation to be had. And frankly, in the current environment, at the current time, this conversation is probably more important. Right, let me bring Damien in and we'll get going with the proper part of the show. Damien, hello, welcome back.
Hi, Martin, how you going?
I'm very good. How are you doing?
Very well, very well. It's been, as I said, a very busy time in markets for the last couple of days. Very exciting.
Yeah.
But, this is a sort of time when things go on that's well worth talking about.
Yeah, and I think sometimes, there are 2 thoughts or maybe 3 thoughts that I've got. The first is perspective is really, really important, right? So the markets are down, but they're still significantly up from where they were a few months ago, right? The second point is that there's a lot of difference between signal and noise. So, there's a lot of stupidity going on, people calling for emergency Fed rate cuts and all sorts of silly things. Some of those some of those from traders. Traders, of course, love volatility, and so trade on the noise. But so it's important to think about signal versus noise. And I think the third thing is from an investment point of view, panicking is not necessarily the right thing to do. Sometimes it's important just to take a breath and say, okay, things are a bit wobbly, but it's not that serious. But then, of course, the other point is at some points,
sometimes you do need to panic.
These inflection points, these changes of trajectory are really important. And I've lived through a number of significant corrections. I can still remember, I think, 1997, the .com bubble, and the Asian crisis. So there have been points at which those inflections, although they started as relatively small events, translated into much bigger and more consequential changes to the market. So it's important to try and separate signal from noise, understand what's going on, and make rational decisions. And I would come back to this point. There's a huge difference between a trader and somebody who's in the market as an investor.
Yeah, absolutely. And so, and I think that's where I'd probably lead from that same point, is saying, look, you look at the price action over the last couple of days, and if you use that alone, you're looking, say, at the Japanese market is a great example. It's down 20, 25, or was down 20, 25% at the bottom of it. Massive big bounce back today, but yeah, you look at that and you go, okay, isn't that a terrible event? And then what you do is you go back and say, well, it's still up over the year since the start of the year. Like, it's in perspective, it's it's all about the questioning and where you're from, and then it also depends upon the perspective of investors from where you're investing. So, and this is one of there's this part about having diversified portfolio, but it's also knowing about what your currency is doing and what it's likely to do in times of stress. And the Aussie dollar is Australia's this growth economy. When you hit these periods of stress, the Aussie dollar usually falls, and it gives you a very different outcome. So if you're a Japanese investor over the last week, you've just dusted 25% of your stock market in a week. And if you'd invested overseas, overseas market might only be down 10%, but actually your currency is up 15%, and so you've just dusted 25% of your international equities as well. So it's obviously a very scary and significant drawdown for somebody there. In Australia, things work in the opposite direction. So our currency moves the other way. And so if you, let's say, as an extreme example, an Aussie investor investing in Japanese stocks, the Aussie dollar versus the Japanese yen over a month or so is up about 15%. So you might be down 20-something% on your Japanese equities, but you've got 15% of it back from the currency movement. And so the actual effect on your portfolio is much, much lower. So for Aussie investors, often these times of turmoil, the currency moves in the opposite direction, and it just buffers that fall. It still falls, like it very rarely does it ever overwhelm the amount, but it means the ride is usually a lot smoother if you're investing in international equities from within Australia. And so it's sort of a bit of a quirk of just how the economy is set up.
And it's interesting because Michelle Bullock in her press conference this afternoon specifically referred to some of the flexibility in the Australian economy because of the exchange rate movements that we've got and those sorts of things. And that takes us quite nicely into just observing what Michelle Bullock said and did and what happened to the market. So here's the quick summary. The ASX 200 actually was up a little. So rather than the previous time, of course, when it was significant down. The RBA held the cash rate at 4.35%. And the question, of course, is that, what happens next? Now, it's interesting that the conversations around this, particularly in the media, were quite interesting, that the RBA is in no place to comfort fearful investors. They talked about a tightrope, little room to encourage investors, flagging animal spirits, fragile psyche of the markets, etc., etc. But if you actually look at what she said, it was pretty straightforward. They're going to keep it unchanged. Inflation is still above the midpoint. The latest numbers demonstrate that inflation is proving persistent. Well, we knew all of that, of course. And then she went on to say things like the economic outlook's uncertain, substantial uncertainty about the forecasts, momentum in economic activity is weak, uncertainty about the overseas outlook, and therefore basically saying, well, we're going to focus on inflation. It's interesting, if you look at the count of inflation versus the count of references to employment, inflation wins handsomely. Inflation is in underlying terms is too high, vigilant to the upside risks, data and evolving assessment of risk to guide decision, and they remain resolute. But it's interesting if you look at what it translates to. This is actually their headline inflation forecast. So basically the headline forecast is dipping thanks to the support from the government, but their underlying inflation forecasts really just reflect that and are moving out now. So we're looking at 2026 before we really see it come into band. And in fact, this table was quite interesting from the Statement of Monetary Policy that showed that the CPI inflation was down a bit compared with last time because of the government support. But the trimmed mean inflation, the one they're really guided by, well, it's still hanging around and is now looking troublesome until the next year. So all of that, Damien, says to me that the RBA has some trouble. But they did also make a reference specifically to the fact that the markets who were pricing in significant rate cuts this year now, compared with previously, were probably over-egging the cake. Now, I go back 2 or 3 years, and there were another time when, in fact, the markets were saying you should raise rates, and they didn't. But, who knows? But it is worth just reflecting on the fact that the forward projections from the markets, if you look at them now, are actually saying, yeah, there's going to be a cut, and it's going to come before the end of the year. So that's 4% by December. Whereas going back to July, there was a rise. So some things have changed, but I wonder to what extent things have really changed. And to my mind, there wasn't really a lot of new news in the RBA press conference.
No, can I show this this inflation chart, this longer term one? If you can pop that up.
Here you go.
So this has got 3 different lines on it, and one of them is the ABS, the quarterly number. That's the sort of the darker, I don't know what you call it, brownish, orangish color. And then the lighter one is the monthly ABS, and then we've got the Melbourne Institute, their survey. And so I think the broad sweep of it is, look, inflation's falling, and if you think the Melbourne Institute is in any way, and having said that, Melbourne Institute can diverge quite significantly for periods of time, and has done in the past, but it's sort of got this story which is, we've been in this big rise, and now we're in this big fall. And I think in terms of the actual inflation numbers, the ABS numbers they actually fell a lot faster than people were expecting. Like they're expecting that. So I think there was this part where to the end of 2023, they that drop was a lot steeper than everyone thought, and now there's a little bit of give back in terms of it. And so it fell more, and now there's been this slight rise. And so, if you average out the two, is like, well, it still does look like it's broadly falling. The question is whether you've got some of these other issues with the housing, the energy, and those types of costs that really are outside the realm of interest rates anyway. They seem to be the one that's sort of the stickiest in terms of this. And as you said, employment's been pretty weak. And so I guess I keep looking and seeing, in a broad sense, the world is inflation around the world is slowing quite quickly. Australia is lagged in terms of that. I think Japan is another good example of a lagged economy. But the broad sweep of it's still in place, and now it's a question of saying, well, are we reading too much into? So I think people read too much in 6 months ago into how fast inflation's falling much faster than expected, and now they're reading too much into there's this bounce back and inflation's now a problem within Australia. I think the true answer is somewhere in between those two, and the numbers are inflation is falling back, and that's if inflation is falling back, and that's you've got your interest rate settings. Do you need to keep if you didn't need 5% interest rates when inflation hit 7%, do you need it at 3.5% on the way down? And the answer to me would seem to be no, but maybe they'll be spooked into it. Certainly the markets are doing their best to help the RBA keep interest rates low and cut earlier. And certainly we've seen bond yields. That's the other side, is that if you do have a diversified portfolio and you do have a reasonable amount of bonds, that's where we've seen markets have fallen back. Bonds meanwhile have gone up, and there's your chance to do a little bit of switching around that and sell out some bonds and buy some buy some equities.
Yeah, and as with all of these things, of course, the whole trajectory of inflation is always a little bit worrisome, and the averages that are quoted aren't actually necessarily reflecting the reality of real people. There was this chart that was quite interesting, and this thanks for Cookie Boy for it, that showed that household paying prices are rising, and they look at some of the international holidays up dramatically: oils and fats, insurance, eggs, cheese, gas, electricity, more than 20%, new homes 19%. This is basically from 2022. So we're in the situation where for many people, the household pain is dramatic. I'm seeing it in my stress surveys too. And then Warren Hogan chimed in, and I thought this was quite an interesting observation, because he said no rate hike from the RBA today, but they're holding their finger over the interest rate hike trigger. But then made the point that the have revised down wages growth forecasts, which combined with upward revision to underlying inflation is basically a significant downward revision to real wages growth for the next couple of years. Why? And why aren't people commenting on this? I think that's a very good point, because real wages have not actually hanging in. No point on the second. But the reason for the forecast change is a big downward revision to productivity. If they didn't revise wages growth down, then they would have had to revise inflation up. Productivity is the problem. And I think that's part of the interesting observation here, Damien, in terms of the complexity, right? Because you've got the pressure on not all households, because not all households are equally leveraged up. We know that quite a few people are struggling. We also know that inflation is much higher for many people than the official numbers. But then you've got this productivity question and this wages growth question. And if you stand back and just think about the overall economy, what we've actually got is a situation where we've got 40 billion of additional stimulus from the government coming in, which is why the public demand is so much stronger than it was, much weaker in the private sector. So you've got an economy being supported by government spending and government investment, including both programs and also support mechanisms for households. You've got a relatively weak economic climate for a lot of households. You've got interest rates that are still relatively low on an international basis, but obviously when inflation was 7 and 8%, that's a different story to when inflation is 3 and a bit percent. And you've got this sort of situation where the RBA is taking the market projection of future interest rates and using that to baseline their modeling to be able to actually then come up with forecasts, which always felt to me a completely circular in argument. And if you stand back and think about it, you think, well, there are lots of questions here, lots of questions about what they're doing it, how they're doing it, and whether they are really being part of the problem or part of the solution. And I guess that's the big question. But, from the point of view of where we are internationally, we had a rate cut in the UK with the Bank of England, the Euro cut. We've had in Switzerland and a few other places too, Scandinavian countries, not in the US yet. So it's fascinating.
Yes, well, and then a rate rise in Japan, and we saw the effect of a rate rise in Japan. I think that the other thing I think that's worth commenting is that there is a little bit of the carry trade. Not a little bit. There's a lot of the carry trade argument within that is in terms of that how weak the Japanese market has been, but there's also an element of, well, are these guys got it wrong? Are they going to be tight? Are they doing what the Japanese prior to the previous governor was very well known for, was raising rates at exactly the wrong point of time. Like just as things were growth was starting to come back, they raised rates and stamp it all out again. And the question is that what they're doing this time again? And so, and I wonder if that doesn't turn around to the Australian RBA as well and go, well, okay, so everyone else is cutting rates. Japan went the other way this week, and the stock market promptly fell 20%. And the currency's risen 15 and all this stuff's going on. Do we want us to follow that? I mean, I know we're not quite the same, but it's not that dissimilar in terms of saying, is there is some of that a commentary on this central bank's just out of step? And that's one part. And the other one is worth noting is, look, Australia obviously didn't experience this inflation all on its own. The entire world went through this inflation cycle. The rest of the world is all cutting their interest rates because they've sort of cured the inflation, and Australia was sort of has got lagged. And we do have some other issues in terms of the amount of the population growth and things like that, and energy, and there's a few other bits and pieces going on. But I think if anything, this it's to look back and say, hey, we just went through this cycle where inflation hit 7 or 8%. In Australia and right around the rest of the world, and the rest of the world has all fallen away, and Australia is on this downward trajectory, but all of a sudden we need to be raising rates as everyone else is cutting rates. I think there's a certain amount of, I guess you'd say you might be figuring your own actions are more important than maybe they actually are. Australia is a small economy in a big world, and a lot of things were affected by outside forces. and both in a good way and a bad way. And so, and I do think that that's where you can overemphasize the effect the RBA. I mean, it certainly has an effect on inflation, but when we've just been through this period where the inflation clearly wasn't driven by local factors in Australia, to then turn around and say, well, that's local factors are what's going to drive it back further down. Yeah, I don't know. So there's that.
Let me just come back on that, because you mentioned Japan, and I think we should probably explore Japan a little bit more. Right? There are a lot of concepts to unpack with regard to Japan, not least the carry trade concept, because of course the rates in Japan have been very, very low for a long period of time. Then we had a very small increment, so they're just moving up slightly, but it had a huge impact. So let's just unpack a couple of things. The first is this concept of the carry trade, and I'll give you my simple view of what it is, and then we'll go from there perhaps. So basically, you could borrow in Japan for almost zero cost, and then you could use that money to go and buy assets in other places around the world and make a return, except of course that you are caught if rates start to go out and the exchange rate starts to move against you. And of course the exchange rate has moved dramatically. And so this is a combination of interest rate movements small, exchange rate movements very large, and a lot of traders dramatically out of position.
Yeah. And so it's these small movements extrapolated out and saying, where does that lead us? And so in one part, it's yes, Japan is different. They're on a different time cycle. They didn't go through anywhere near the inflation shock, and so they're now getting this inflation shock later, and so they're going to need to hike rates to hold the whole thing in. Or the other view is what I spoke before, is that every time growth pokes its head up in Japan, every sort of 10, 15 years, then they raise interest rates a bit and they squash growth and they go back through the same cycle again. And so I do think Japan is quite different now to how it's been over the last 10, 20 years. I think most of the debt has been worked through from a corporate perspective. The corporates are making pretty decent margins. It is looking much better from that perspective. So that's a positive side. On the flip side is a lot of their corporates are exporters, and so when the currency just moves 15%, that's going to put a big dent in their earnings. So the earnings look very cheap now in Japan. I've got a chart maybe of the Japanese. It's sort of sitting, and now this was before the bounce today, so this is as at yesterday. And so what I'm showing here is the Japan, excluding banks and resources, the price to earnings ratio versus the world for the last 20 or 25 odd years. And so, it used to be for most of the early 2000s, Japan was trading at a premium to the rest of the world. Then it sort of gradually worked its way into a discount, and the some of those drops you can see. I think that's Fukushima, maybe. But we're at a 36%, whereas yesterday was a 36% discount to the rest of the world in terms of valuations. Now, some of that will go away once you factor in the sudden price movements you saw in currencies, but still, it's basically trading as cheap as it's traded ever. It's on certainly in the last sort of 20, 30 years. It's in terms of price to earnings ratios, it's sort of 11.7. It's probably really on more like 12 or 13, but yeah, it's cheap. It's for 50. Yeah, as you say, much cheaper than the rest of the world. So from that perspective, there's some sort of interesting things. There's some of the companies have popped up quite interesting, and this is over the last couple of days, and particularly yesterday, that sort of all of a sudden become attractive in terms of buying. And this is the question, I guess, all this volatility sort of should keep coming back to, is first of all, what's your plan when these things happen? Like, do you have a list of things you want to buy, and you're waiting, and as these prices go nuts, you're like, hey, that's a company I really like. Prices suddenly tumbled. I'm actually going to take the opportunity to jump in and buy some of that. because you do get a lot of this sort of volatility throws up a lot of these opportunities. The other thing then is coming back to that, is this the time, of the times when markets go through these downturns and you get sort of these 10% corrections, sometimes it's genuine and it is time to panic, and sometimes it's not. And I'll run through some of the fundamentals that I'm looking at. Maybe the fundamentals will get the markets being really forward looking, and it's looking at some of these fundamentals and it's extrapolating out things that are going to happen over the next year or 2 years. But certainly from a big picture sense, the fundamentals still look pretty good. Like, it does look as if there's been, this is sort of some short-term measures. So I've got a chart just showing this is. So I'm going to start with the sort of the ones which saying if you're worried about things getting worse, then this is potentially what you might look at. And so what is the chart showing? Sorry, it's possibly a little small to see on the screen, but the top chart is showing back in start of May, where were we seeing economic surprise and which sectors? So we're seeing this positive surprise in the labor market, personal household sector, and the retail and wholesale sector. And this is a US economy. So sort of where I guess things are driving, but then industrial and business cycles were all pretty negative. And then you flip forward to yesterday, and now you're actually looking at the labor market having flipped around, the personal and household going from a relatively big positive to a small negative. Now, these economic surveys and the data, you can often get head fakes in them, and analysts do tend to go from being too positive on one side to too negative on the other. I guess what I'm saying is that one could turn around quite quickly. The other one, though, that might give you sort of some more pause is saying this is just a chart of systematic equity positioning. So it's basically saying there's a bunch of traders out there, and everyone's trying to work out what are the traders doing and when are they too far overweight and when they're too far underweight. And you sort of want to take the opposite view most of the time. So while everyone's buying in, you're sort of like saying, okay, well, trend is your friend, and you've got all these people still pushing markets up. But if they hit once they hit the extremes, you can see on this chart, the lines downward are pretty sharp. And what it is, it's usually because they go from being, everyone's overweight, there's no one left to buy, and you get a bit of bad news, and then all of a sudden these guys start selling, and then that selling then triggers more signals in their models to keep selling, and you go through this whole cycle. And the idea is that there's sort of, in a broad sense, you're talking about three different types of investors out there. You've got these short-term momentum players, which are getting bigger in recent times, at least, and they sort of cycle as to how big they are in the market. But they're the ones that will jump in and out of stocks, and they don't really care about the prices. It's all about the story and the momentum. And so you often hear them spoken at as CTAs, or commodity trading advisors, and different names, whether it's hedge funds or other there's all these different strategies that sort of can fall into this same bucket. But the idea is these people aren't really price sensitive in the sense is they're happy to buy expensive stuff as long as they're going up, and happy to sell cheap stuff as long as it keeps going down. Then you've got the people that sit in the middle that are more like myself and a lot of other asset allocators that are out there trying to outperform other asset classes. And so what they're doing is trying to make a call about whether equity is expensive. Are they going through some good growth prospects? Are bonds expensive? And so we'll be using these opportunities to say, right, the flip between bonds and equities has just changed. And if my fundamental view hasn't changed, now I'm starting to reallocate my portfolio. And some people are sort of like us, and they'll do it on a more frequent basis. And there's a lot of sort of more slow-moving ones that sort of look at this on a quarterly or monthly basis and tend just to sort of quite slowly move into it. But they'll do that switching between equities and bonds and cash, and they'll help to sort of smooth out some of these factors. And then the last group is the people who don't need to be invested in the market. They're not. They might be people who got a choice between having a lot of money in cash or a lot of money in property or whatever it is, and they'll be like, oh, hey, the whole market is absolutely cheap right now. We're going to move into the entire market, or the whole market's getting expensive. I'm just going to move my money out. And so the idea is that these three groups between them sort of determine the path, in that, the momentum guys start selling and they push it down and they push it down, and then people like us start to get back in and buy a little bit, and then at some point the markets will get low enough that these the high net worths will start moving money out of whatever assets have got them in and start moving them into sort of cheaper markets, and that sort of balances the market, and then you go off the other direction, and it plays out in the reverse. And so if your view is that, look, we're headed for a recession, fundamentals are going to get worse, and this is just the tip of the iceberg, then you look at this chart and you go, well, we've come down a fair way in terms of the overweight, but there's lots more to go. Like if you're bearish and you're concerned about recessions and concerned about markets being overhyped and everything like that, you could use that chart to say, yes, we've come off the peaks, but we can go out the other side as well. And so, that alone could drive it down, and then you start getting earnings coming through weak and all these other factors that sort of end up giving you this quite negative sort of outlook for it. Okay, so that's the sort of your short-term sort of proximate cause for it, and then the trading side of it. The next part is, well, where are prices? So we're at sorry, no, you can't quite see that. The big dot shows where we are. We're at the 80th percentile for being expensive, so we're certainly not cheap. 19.6, and that's certainly come off from where it was, but it's by no means cheap. And if you had that argument that, look, we're heading into recession, earnings, valuations are going to fall back to sort of at least average or below average, then there's an argument for another 20% you can knock off stock markets and things like that. Then you go, okay, well, now what's happening at the earnings side? So that's where the core of it. Now, earnings could get worse, but it's pretty good at the moment. It's actually better than it's been for a while. So I've got this chart, and I've just picked the US market because there's some nice charts you can get easily on this data. But these are lines basically showing what are people expecting for 2023, 2024, and 2025. And then the red line is what is the sort of rolling 12-month forward numbers doing. So every month you get like 1 month less of 2024 and 1 month more of 2025. And when that red line's rising, that's usually pretty good for stock markets, because the fundamental underlying earnings are going up. And that's where, we certainly haven't seen any signs of that turning down. And this reporting season's actually been one of the better ones we've seen. Certainly way better than most of the other ones recently. So, probably people are used to me getting on this podcast, Martin, and talking about how analysts keep forecasting 5 to 10% growth, and then every quarter it comes in at -5. And then they just reset their forecast and go forward again. And next quarter, everything will be great next quarter, and then it's not. And everything will be great, and then next quarter it's not. This was the quarter it actually was good. So, they were forecasting the 5 to 10%. We're coming in. It looks like it'll be sort of 6% growth. And so, so the fundamentals haven't really started falling away at all at the moment. So, not to say that they can't, but it's it's pretty rare that you would start a long-term downtrend in the market with earnings looking like they're looking at the moment in terms of the earnings growth. And you can see that I've sort of picked this chart in particular because you can see that red line throughout 2022 was falling. So we were seeing downgrades in the 2023 numbers and downgrades in the 2024 numbers. And so the red line, which usually goes up over a longer period of time, was actually falling, and that was what sparked that really bad year in 2022 for equities. And this is just a longer term look. So same line, but just drawn out over, I don't know, maybe 30, 40 years. And you can just see that red line. Yeah, it goes through some big downturns from time to time, but there's not many downturns that it goes through. It's usually sort of on its way up over time. And so that's, so nothing, there's certainly nothing on that front that would sort of say to you, it's time to panic. And usually when we do get to the downturns, you've had a lot of other signs going on about things that are going wrong. If this time around it was I don't know, a bunch of commercial properties going under, or some high profile business losses in the US, and that was starting to spiral, and this was the start. This was, earnings were still looking pretty good, but we had all these bad debts and these companies starting to fall over left, right, and center. Then that's where I'd be saying, okay, maybe this is a sign of something more concerning. But we really just haven't seen any massive signs of that yet. They might come. Maybe this will be one of the most forward-looking markets we've seen, but usually the market will wait until it really sees that the whites of the eyes before sort of factoring in those types of events. And the only other one, we speak about this often, is this same chart, but sort of looked at year by year and just put into a growth rate, because that's where we've spoken before that, analysts basically start with what do they think next year is going to be, and they say 10% is almost always that. You can just see that all these lines start at 10%, and then they cut one direction or the other as the earnings start to come in. So when you're a year away, people are always like, yep, earnings are going to be 10%. And even the really good years, so you can see that 2021 year, maybe 2022, there was a cracking year. 2021, which was sort of up 50%. A lot of that was tax cuts and other things like that were sort of all in. But at the start of that, 2 years earlier, everyone was expecting 10% growth. And the next year, the really bad year of COVID, everyone was expecting 10% growth until they didn't. And you go back into even big downturn years like 2014, 2015, where we had a couple of sort of negative years. Analysts started at 10%, and that's exactly what we saw for 2023. 2024 so far is hanging in there at 10%, and we're seeing 2025 earnings are rising at the moment in terms of the forecasts. So so fundamentals from an earnings perspective are looking pretty good. The economics do look like there's some negative numbers, but again, they're relatively mild. You can never say if these things do turn into something more severe, but at the moment, it certainly looks like the fundamentals are relatively good. The market certainly ran away with itself and ran up to very, very quickly. And this, if this sort of stopped where it was and kept on going, it would be looked upon as a pretty, it's a pretty frequent event for bull markets to have these pullbacks and then to start again.
So there's a couple of questions that follow up from that. Some of those charts there, which shows the earning growth, that's not inflation adjusted, is it? That's actually the absolute earnings. And
that's right.
If you were to overlay inflation on that, of course, then that could pivot the numbers significantly. The recent numbers, yes, but actually, most of that time we had no inflation. But that's my point. So the recent uptick, right, some of that is reflecting high inflation, right? So,
but it actually probably inflation, I think, would make. Let me put it another way: inflation would make that downturn look way worse, because that was when we had falling earnings and 7% inflation, and so now we've got earnings that are going up by 10%. Yeah, we've got 3% inflation or 4% inflation. Call it 5% if you want.
Yeah.
Like we're still talking about doubling inflation in terms of the earnings growth, and a real earnings growth of 5%. That's a pretty cracking growth. Like that's higher than I'd expect over the longer term. So yeah, I do have a breakdown of that. I'm just trying to think how it falls out, because when you look back at I've got that chart. So I feel like if you go real growth. So if you look over the last sort of 40, 50 years, I think you go real growth of about 60% in terms of earnings growth. Mm-hmm. But when you break that down as to where that came from, 2 of that came from falling tax rates. So you're like, okay, of the 6% real growth we got was just because we cut taxes. So that gives you sort of 4% more nominal growth. And then of that growth, you then go... you look at buybacks and all that type of stuff, took another big chunk out of that. And so when you nut out the changes in shares and a few other factors, it's more like 2% real growth. So we've had 6, but a lot of these is tax cuts and changes in the number of shares. And there's another factor as well. It's completely eluding me. But you get back to about a 2% real growth. So if we're growing at 5% real, I'm happy days. Yeah.
And that's actually the point I was going to make, that, if you actually then overlay what inflation has done, so the real value of your dollar is being depreciated by the inflation level each year, and then you overlay that into stocks, or indeed investment property returns, or I guess even term deposits, then the true growth or lack of it really is quite stark. And for many people, they're still going backwards in real terms, even if they're actually invested in the market. So that's a really interesting and important observation. The other one I wanted to just come to was a lot of the US companies who reported in the consumer sector, everything from McDonald's to Starbucks and others as well, some of the big retailers, all said there are significant signs in the US of consumers now closing their wallets, going for cheaper alternatives, spending less. And bearing in mind that I think it's something like 7% of global activity, economically speaking, is the US consumer, that potentially, if that goes a bit sour, could actually be quite a significant impact, not just on the US, more broadly as well. So, the signs are complex, because the job numbers were a bit down this time around. That's one of the reasons why the markets wobbled on Friday, although actually 100 and something thousand, 111 or 114,000. If you go back a year or two or three, that's actually quite a good growth level. So we've been used to a much higher level than that, but we're artificially so. If you go back pre-COVID, then that growth level would have been seen as pretty stellar. So there's an issue
and
there.
Then there's the hurricane effect, where they're saying, oh no, there's no effect, but others are saying no, there was actually a big effect of all these people, and so maybe it was much stronger than so.
Yeah, and then they always revise them heavily afterwards. So it may well be that the next month's data comes in at a different level. In fact, one of the Fed speakers over the last day or two made the point that, of course, these numbers are wobbly and they do get moved around quite a lot. So you can't necessarily rely on that point. So I guess my point is that if you look at the broader economic data, and you can look at the US as an example of this, it is quite mixed, but there are still some significant dynamos of profitability still in the system. And I find that fascinating. And then, of course, I find it fascinating that Warren Buffett sold a significant chunk of Apple, thinking, well, it might be actually a good time to deleverage and rebalance the portfolios. And I know that Jeff Bezos also sold some Amazon stock relatively close to the top two. So there's some interesting questions then. When stocks have had a huge run and you therefore are significantly overexposed to particular sectors, is it time then to sort of to reset and review? And it goes back to this question of how often do you rebalance and how do you rebalance? And and when the markets are moving around like they are, how does that impact the way that you think about any rebalancing you might do?
Yeah, well, in terms of the rebalancing, all the time, all the freaking time is the answer. Is that you should be keeping an eye on these, and when your sectors are getting when you're too overweight in particular stocks or particular sectors, you need to keep taking the profits off the top of that. And so whatever your mechanism is to do that, you need some sort of mean reverting type factor that's sort of helping you to sort of bring that in. So so for example, just the way I run it is I like to look at quality and value. And so I basically say, look, if I'm buying a really high quality stock, I can pay up for it. If I'm buying just an average quality stock, then I need to find it cheap. And that's sort of my my mantra. And so, it's and then we run models over the top of every stock we've got. And so then it says, okay, well, look, you bought this stock because you thought it was average quality and it's just doubled in price. Well, it's time to sell. And the discipline is, if I need to and something's changed, I can go back and justify as keeping it. But the model's telling me, hey, you bought this because it's average quality but cheap, and now it's average quality but not cheap. You need to sell it versus a very high quality stock where you can say, okay, well, look, I've bought that because it's really high quality, generating good returns and getting long term growth. I've got more scope. That goes up in value. Yeah, I've got more scope to hold on to that for longer. And so whatever the mechanism you decide to use, you need something that's actually that independent, looking at your portfolio. I've got too much in this. Do I just need to rebalance it back? Or at least just stop buying, because you're always getting dividends through. I'm not buying any more of that sector because I've got heaps of it. I'm going to just reinvest all those dividends back into other sectors and bring my weight down, by effectively by doing that same type of thing. So all the time, these events, look, it's hard to say that it's a good time to rebalance. It's often time when people do the wrong rebalance, because what they do is they go, I had too much risk, and now the market falls a dramatic amount, and as it hits the bottom, now I'm tipping back out and getting rid of all my risk at exactly the wrong point. So there's some of that. It's about that pre-planning and going, okay, when the market falls back, you need to have your plan about what you're going to do beforehand. It's why you do your fire drills, and okay, well, if there's a fire, here's where I'm going, and this is what I'm doing, and that's where we're going to meet afterwards, and all that sort of stuff. For the first, when there is a fire, that then being the first time you're thinking about how you're going to get out is the worst time. So if you haven't got one for this time around, get one. and the idea is when these things happen, this is the time where, as I said, you get stocks that just good quality stocks that are just going to tumble because they happen to have a bad announcement on the day that everyone was panicking about everything, and something that might have caused the stock to fall 2% causes the stock to fall 20. And it's a chance to go, well, now I've got a chance to pick that one up and flip between them. So I like to think of market events like this as an opportunity to increase the quality of your portfolio. Because what you can usually do is buy high quality stocks cheaper. And there is an element as well when in some of the first days of market sort of corrections, is that it can be some of the most liquid stocks and some of the best quality stocks that actually fall even more in some of those early days, because people are just getting rid of whatever they've got, and they're like, you sell what you can, not what you want to. It is sort of, especially in some of the traders where they're just like, I've got this portfolio of all these stocks. Some of them are illiquid, some of them are liquid. I just need to get out. I'm getting out of the liquid ones first, and I'll try and get rid of the liquid ones later. And so that's where, just more about use this as an opportunity to try and improve the quality of your portfolio.
And I think that's a really important message, because certainly over the years, I've seen a number of individual investors who start to panic when they see all of the noise that's out there, and stock markets are down 10%, and in fact that's often not the right time to be thinking about selling, because often what you're doing is you're crystallizing potentially losses that you don't need to crystallize, or profits that are significantly down. But you need a plan, and that basically says that over the next little while, if this happens, then effectively I have cash available so I can go and buy those. And so you get a relative sense of value. I actually think that's quite an important little lesson here, that don't be thinking like a trader, because going back to your point about these different herds of different types of investors, the traders love volatility, right? And also, of course, volatility is being exacerbated now by all of those electronic trades, those program trades, those computer trades, which tends to exacerbate the swings up and also the swings down. And I think that's something else that some people have probably lost sight of in all of this. I don't know what proportion of the trades were electronically driven over the last 2 or 3 days, but my hypothesis would be a hell of a lot of them were.
And so that's one of these key things with it. There's a whole industry now in sort of trying to second guess some of what these commodity trader advisors are doing, because they all use the similar models. Well, not all, sorry. The vast majority of them use similar models, and they tend to be momentum type models, and momentum type models are pretty well defined, and most people use the same ones, and it's the same signals, so they use them because they work. But what it means is, when as they're looking at them, there's this whole industry in terms of looking at, okay, what are the levels where, if the price, the price is $100, if it reaches 105, that's going to be some level of 9-month performance or whatever it is, or reversals, and all, there's all these different sort of factors that go into it. And that's actually going to, if it hits 105, that's actually going to spark this whole wave of another buying. But actually, if it falls to 98, actually that's a different level, and that's going to spark a whole bunch of that could start sparking a whole bunch of sellings. And if it hits the 98, that'll spark enough selling to get it 95, which will spark more selling. And so there's a whole sort of second guessing around those, and they're very much these. On one hand this, and on the other hand that. But it's interesting from my perspective anyway, just sort of knowing, look, I don't trade off this, but it's interesting to know that what are the key levels out there that that's just going to spark programmatic trading, and it's not even, there's no thinking about it. None of these guys sit there and go, well, XYZ stock just hit this level, but actually the fundamentals are really good, and look, it's got these earnings reports and this is that. It's just like, no. I'd look at the price. That's the only, that's effectively the only thing that goes into these models. So if that happens, then this is the automatic response. And so that's what sort of creates that short-term twist, right? And so and the other thing to note as well is, for the average stock to have a 30 or 40% trading band over a year is relatively common for most stocks over that period. And so, and that's that idea that if you've got, for me at least, is saying, I need to know why I'm buying companies. If I'm buying this company on a longer term theme and I think it's good quality and earning good returns, then I can ride the volatility through. It's not it's not as much of an issue about, okay, the stock comes back, well, I'm buying more of it. Stock goes up. Do I want to lighten it, or do I just want to not buy any more, or whatever it is? Very different to when I'm playing around in low quality stocks or even just average quality stocks. I want to be buying these when they're cheap, and it's just a stock standard average stock. If I can buy it cheap, great. If it starts getting expensive, it's time to sell. Move on to the next one. There's always something out there that's on a relative sense that's going to be cheap, and so having that sort of discipline is important.
Yeah, and that basically means eternal attention is required, right? So you can't sort of set and forget and come back once a year and say, right, now what do I do? Because effectively what you've done is to miss those critical points in the market through the year. And I think your point about the fact that stocks do move around in terms of value is a really important one. There's another perspective too, which I just want to share, and that's, let's go here. This is actually the most recent US 500 distribution. And it's quite an interesting chart, right? Because it has got two things. It shows you the relativity of the different stocks in terms of their impact on the market, and also the recent movements. Anything in red is more than 3% down over the last 24 hours. But I just want to highlight a couple of things. The first is, look how strong the technology sector is represented in the US with Nvidia, Microsoft, Apple, Google, Meta, Amazon, and then Tesla. Right. Well,
and noting as well, Google and Meta are communication services, not even and Amazon's a consumer company.
Exactly.
So Tesla, Amazon, are consumer companies. So
isn't
there's a lot
interesting
in the definitions.
Yeah, but the other point there is, look at the banks, and look at the size of Citibank C or JP Morgan, right? And then consider the movement in Nvidia since its peak. Nvidia has lost more than the entire capitalization of some of the banks. That gives you a little bit of a flavor of some of the complexity here, right? And I think it's just worth highlighting just how much the tech sector in the US is driving everything. And that's, of course, why the NASDAQ and the general Dow goes in a bit of a different direction. But I always look at this chart because it shows me some quite interesting things. And of course, normally you don't have so much red across the whole screen, but it does show you also that even on the last 24 hours or so, not everything moved in the same direction at the same amount.
No, and Nvidia is a great one to show. I did look at the numbers. I've forgotten what they actually were on Nvidia, but it's because of this fall. It's come off quite steeply, and it was sort of swinging around pretty wildly from day to day. But it's right back to where it was in May. It's sort of a whole 4 months worth of
I think
worth of performance. And
I can put that up. Hang on, I've got it here.
Yeah,
there you go.
Year to date, it's
there you go.
Year to date, it's up 108%.
So of course,
we have got the split in there. You just get a split adjusted one.
Yeah, but you can see there that back in September it was 45, went up to 140 at the peak. It's now back at 100, right?
Yeah,
I mean that's a considerable move given the time period we're talking about.
And on you say so in 8 months from 7 months and 6 days since the start of the year, we've it's up 108%. So it's
exactly right.
There is certainly an element of trying to map that back to things do get overbought and then they come back and it's time to move on to the next one or if you like it as an element in your portfolio and you look at an Nvidia and go high quality, generating these great returns, I'm happy to, I won't buy any more at some of the peaks, but I'm happy to hold it. And then as it falls back, saying, okay, now is it time to buy some more? And so, that's one as well where it's on 30 times next year's earnings now. It's 25 times the year after's earnings. The market multiple is only just below 20. So it's and it's probably one of the highest growth companies out there. It's if you look at it on a cash flow basis, it's sort of at the 75th percentile of stocks in terms of cash generation versus price. And so, 70, whatever it is, top 25%. Is that the top 25%? And you're like, well, is it the 25th best stock out there, 25th percentile, or is it actually in the top 5% of stocks in terms of growth? And so, there's certainly elements around stocks like that about, making a decision about where it's, is effectively the decision for NVIDIA is, are they a supplier of a relatively small, sorry, not a relatively small, of a critical but one part of a computer that can generate AI calculations, or actually do they have the ecosystem and the a whole bunch of the technology of a whole new data center structure that's rolling out now, that's GPU based, and I think we spoke last time for anyone who's tipping in on about that. And so, if you think if they're just a supplier of GPUs to this sector that needs them, then they're overpriced, and it's over, and it's time to get out of it. If they are genuinely the architect and the basis of these whole new data centers is going to be rolled out everywhere, then there's a reasonable argument that they're still relatively cheap.
Yeah, and it's interesting if you look at the recent results, of course. Google, for example, who's investing big on CapEx into AI, got punished because they couldn't see where the revenue was coming from. Apple, on the other hand, still investing big in AI, was able to convince people that the next generation of phones will actually be the device that will actually be the champion of AI, and suddenly, and so if you look at the Apple story in terms of their shares, this is going right back from 2013. Right, it was at 20, and now it's up to 209. Peak was 234, and it's interesting that Warren Buffett sold close to the top, and it's, when you look at that trend, you think, that's interesting. So what's the value story there?
So we're a big. We had lots of Apple sort of back in the 2019. It was basically cheaper than the rest of the market. It was 15 times earnings and all that sort of stuff like that. And now it's closer to 30. So it's basically it's gone from being a relatively cheap stock with a decent growth profile and a high quality stock in terms of its earnings, to something that's quite expensive. And it is, that comes back to that question. And I don't know the answer. Apple's certainly pitching it as your phone is where everyone's going to need to upgrade their phones because they're going to need the AI on the phones. And that's the part I don't know about, because I think the last couple of cycles of phones, they've been struggling to find, here is the killer app you've got to get, because for a while there, it was like every phone was like so much better and the camera's so much better and it's got, the download, and now I can watch movies on it. And, it just, there was a cycle where you have to keep going and cycling and getting a new phone. And that's been dragging out and out and out over the last few years, because there's not a killer app that you look at the iPhone, N and versus the iPhone N-5, and the feature difference hasn't been great enough that people have to rush out. Now, is AI going to be on the phone going to be true? I don't know. My initial expectation was no. Obviously, a lot of people believe the Apple story. But that's been one we've been underweight. We've still got some, but underweight, certainly, versus its market. And sort of, I'm more in the Warren side, that, it's not a stock where we're out chasing, trying to buy it at these levels. We sort of did our selling probably a year ago in it. But I've got a chart up showing the four big ones. So if you take the data center, if you just take what they call the hyperscalers, there's some other ones that sort of probably fit in here as well. But these probably make up 60-70% of the market, which is Meta or Facebook, Microsoft, Google, and Amazon. And that's how much they're spending on CapEx. And the last the last two are the expected levels. But just to give you, by the fourth quarter, we're looking at, annualizing maybe 350 billion worth of CapEx. And so on a revenue basis, if you look at NVIDIA, like the forecast that NVIDIA has, and base it on what these guys are saying, NVIDIA is actually, it's going to be making up a smaller share, I guess, of total CapEx. So so I guess what I'm saying, there's two ways to do these. One is two ways to look at forecast for something like an NVIDIA is you go, okay, let me look at them and try and how much are they selling now? How much are they going to grow? What do we think they can grow it to? And the other way is you go to their customers and you say, well, how much are they spending on CapEx? And what does their growth profile look like? And these numbers can change, but at the moment they look pretty good still. So as you can see from those lines, we're talking about going from, 2022, you're spending, less than 30 billion a quarter. And by the fourth quarter, this one will be spending almost 60. And so, in a 2-year period to double the amount of CapEx for four of the biggest companies in the world is pretty extraordinary. Yes.
Yeah, absolutely. And of course, the question then is, are they going to get the economic momentum off the back of it? And of course, if you look at what Microsoft said, for example, they believe that they'll be selling, AI enhanced services to a whole portfolio of businesses, and that's where a lot of their revenue is going to essentially get enriched from later. So they're making the investment now to be able to actually capitalize on that later. That's the sort of the theory. I've always had the view that the truth of AI, and I'm a believer in the capacity of AI to do a lot of quite significant things quite differently from what we currently do, is when real businesses actually change their broken systems and processes and actually do things way more efficiently and effectively and, with lower error rates. There's so many bad businesses around the world still struggling with old systems and processes. But it is actually an interesting observation that a lot of the improvements in the way that businesses actually work is the marrying of technology with new business processes and ways of thinking. So it isn't just a silver bullet technology solution. It's how you actually change the way that you interact with your customers, for example, and how you make business decisions and how those business decisions can be enabled and enriched by using the right AI capabilities, whatever they may be. And I actually think that journey is probably only just sort of starting out now. And I've had the view for some time. It's a bit like the .com bubble story. The internet in the short term was overhyped, but the long-term benefits of the internet more broadly have been much, much stronger. And that sort of takes you to the really interesting proposition. And I think this chart was one that I may have shared previously, but somebody said, well, let's look at Cisco and NVIDIA, and let's run Cisco back 24 and NVIDIA back 24 years to map with Cisco. And are we seeing the same thing again, that basically we had this massive run up where Cisco was going to be the stock of the future because of the fact that it basically was controlling the rollout of the internet. And then NVIDIA is following on suit. So it's an interesting question to my mind as to whether, in fact, we have a similar thing going on, or whether, in fact, this idea of the capabilities that are being created and enabled through the LLMs and the hyperscalers and those sorts of things are things that can then be filtered through and down into the way that other businesses and businesses' systems and processes and government systems and processes will actually be different. And that, for me, is the challenging, interesting thought about productivity improvements and all those things too.
And I'm on board with the Cisco analogy, down to the point where, because I do think there's this part about your enablers of technology aren't going to be the ones who capture all the benefit from it. Yeah, they're not. It will actually be real companies that get it. I guess my main one on NVIDIA is saying, if it was just a GPU, I'm completely with you on that. If it's the fact that they're actually very good at they've created this whole ecosystem of making GPUs talk to the memory really efficiently, and making GPUs talk to other GPUs, and making systems of GPUs talk to within data centers really efficiently, and they've got that whole ecosystem. I guess all I'm flagging is I still think it's the right analogy, but it just could be that it's equivalent of, I guess, Cisco going, they're not just producing the routers, all of a sudden they're producing better phone lines and better, they're doing, I don't know, they're going from being 10% of a data center and 10% of it, something like that, to being 20 or 30% of it, because they're actually providing all these extra services. But I think you're right in sense of that. The real benefit's going to come later, and I think my analogy on that is that it's going to get worse before it gets better. In that, when banks came out and they, you looked at it and everyone was like, great, I won't have to queue up in banks anymore to deposit my checks, and I'll have all this savings, and banks are going to get to close branches and save all this money on having to manually process, transactions and all this stuff like that. But in the first instance, they still had to have all their branches open because that's where people were still going. And then they had to spend all this extra money on IT to get all the systems up and running so they can actually have the online banking. And so, yes, at the start, it was worse, in a big picture sense. And that's where we are with a lot of the AI stuff, is that, it's a promise. But there's a certain amount of, if you don't do this, your business may not be around. Because if you're the bank who decides, that internet, sure, that doesn't work that well. No one, there's the amount of people actually using internet banking is really small. People are still lining up in banks. I'm not going to do anything. I'm just going to be the bank that keeps doing traditional stuff. Well, in 5 years' time, you're starting to lose all your customers to all the people who have got that. And that's that same thing now, is that if you're say you're a supermarket and you say, you know what, I'm happy just to send people through the checkout still. And you've got other ones going, no, we're going to have these video cameras technologies, and we're going to have automated, robots stacking shelves or whatever it is that you're probably much better off at the moment not spending that money. But in 5 years' time, you might find that all of a sudden they've got, they've cut 30% off their costs, and all of a sudden you're the most expensive producer out there, and you're relying on, those other factors. So, so that's one other part. And the other part is that what's a little bit different this time around as well is governments last time did want to have some internet stuff, but they weren't really in on the whole boom, and they weren't throwing money hand over fist at it because they're just slower, and it takes a while. This time around, militaries do want to be in on the ground floor. They don't want to. There's a FOMO for companies about, I don't want to be left behind, but there's also the fear of loss for some governments as well. And so it's And the other one I did have before we got too far away from that chart you showed as well of that market, I thought I'd show my one, which is a similar one for, I like to think of it as the toll collectors. If you look at the Australian market and you go, okay, there's the mining sector, which is quite unique to the Australian market in terms of how big it is. Most other markets, it's just tiny. Then I throw in all the people who are basically just collecting tolls on other companies. So if you've got this idea, there's companies out there that are creating new things and services and products and selling them to other people. Well, those guys, the banks for them are effectively a negative cost. If the banks are doing really well in an economy, then chances are it's either the consumers or the businesses that are doing poorly in it. And then you go, well, utilities and your infrastructure and REITs, the buildings or the pipelines or the toll roads or the airports, they're largely already built. All they're doing, the guys aren't creating anything. They're just collecting a toll on something that's already been built. And so they're not the dynamic parts of the economy. So if you take all of those and you look at the Australian market, there's, almost 2/3 of the Aussie market is based on those. And everywhere else, it's sort of sub 20 or, at least sub 25%. So, the Australian market, you're getting a very different exposure in terms of stocks when you buy the Aussie market compared to what you get in just about any other country.
So, the point here is they are clipping the tickets effectively at the moment, right? Mm. But then the question is, how much longer will they be able to clip the tickets going forward? That's the fundamental question, isn't it? Because it's not actually productivity improvement. It's not necessarily driving new innovation. No. It's basically looking backwards rather than looking forward, and basically harvesting what the investments were some time ago rather than making investments for the future. And I would say that that's probably the most critical problem that Australia has in its inability to be able to actually craft a more productive and more innovative future.
Yeah. And so, a great example of that is we sold all our electricity networks. And then a few years later, and when we set up these rules around, based on this, what return can you get as an electricity company, so that so we can try and create more of a market, because these are monopolies. So we need to try and work out how do we regulate them so they don't just rip us all off. And then they did rip us all off. They gold plated all their assets, and it took 10 years for us to work out. And then there's all these things. Oh, okay, now we rein them back in. And now they go again on some other, and with all the changes going on, we need to build more of this and more transmission. And, I have no doubt that we're running into exactly those same problems again. And so this is this sort of ongoing problem that Australia has in terms of, one of the reasons why we own Transurban is because our broad big picture view on that is that they're the master of offering state governments, let me give you, Martin, a deal that's going to be fantastic until the next election and then terrible for the rest of your life. And what a great deal for a politician. Fantastic until the next election. That's all I care about. And so, for utility type assets that are already built to be getting above inflation returns is sort of unheard of in a commercial sense, is that utility type assets get inflation minus something as a return, whereas they've managed to turn all these toll roads into inflation plus, and then plus you get all the population movements. And anyway, so
and just on that,
and when do you get a revolution? I guess it's the question. When do you find people go, no, you know what? I don't want to be paying $30 in a toll to travel halfway around Sydney or Melbourne. I'll make
a Zoom call instead, and suddenly the whole model changes. One other observation and point made in the chat just now was a lot of the new jobs that are being created are actually in the public sector, healthcare and those sorts of things. And yes, again, those are important jobs, but relatively low productivity jobs. So if you look at the forward pipeline of prospective productivity improvements and productive investments in Australia, they are pretty much close to zero at the moment. So we are relying on more and more and more government intervention and government investment to try and actually make jobs, to keep people employed, to be able to actually keep the unemployment rate low, and hopefully the tax take up a little bit. But it doesn't necessarily shape the future trajectory of the overall economy in a productive way.
No, and I think this is sort of getting into this whole root cause analysis of some of the issues we've had. And for anyone who's listened in to me before, I've got quite strong views in that I do think there's an element right throughout the 2020s and the 20-teens in terms of we turned a lot of the what we've done is we've increased inequality. And so when you give Gina Reinhart another $1,000, she throws it on the pile and goes and invests it or whatever. She doesn't go out and spend it. When you give our poorest citizens another $1,000, it's gone, on 100 different expenses. And that money circulates in the economy and helps grow and everything like that. So the more you have the richer people getting richer and the poorer people getting doing poorly, you get these slow economies. You can't generate the type of growth. You can hide it for a while by increasing the debt and letting people borrow more and falling interest rates, which is what we did. But you're not getting that sort of ongoing growth. Then we get to this pandemic, which illustrates my point perfectly. We throw all this money to people, to everyone for doing nothing. And all of a sudden inflation goes boom and there's all this growth and it's like, wasn't that terrible? We can't do that again. And so, and the big issue I have in terms of AI is it's going to make it worse. So you're going to find that your smartest lawyers, for example, will no longer need as many juniors. They'll be able to use AI, or they already are using AI to help generate a lot of that type of stuff. Your smartest programmers will no longer need junior programmers to help do, traditionally, I guess your smartest programmer does 80% of the work and then hands it over to the more junior ones to do the documentation and the testing and the, all this other stuff, check the security and all these things. Whereas being done by AI and will keep, moving on. So I guess where I'm coming to from here is that we could see inequality get worse. And if inequality gets worse, then we're looking at the same type of outcome in that low inflation, struggling to get growth, trying to pump debt through everyone, lower interest rates, trying to get everyone to gear up more to try and generate this growth. But it's not the higher quality growth you're going to get from a more even spread. And Interestingly, I think the key factor I'm looking at over the next 5 to 10 years is when does it really start to hit your blue collar jobs and your sort of lower paid jobs? Because the irony has been that it's been hitting the white collar jobs at the moment in terms of AI, and that's probably where the job losses are for the next little while. But once it hits, say you start a whole swath of retail people go out of business because whatever it is, we're stacking shelves more efficiently or moving things around more efficiently, and then in particular some of the driverless car and driverless trucks and logistics, automated logistics. Like that's one of the biggest employers out there. Like that could put a lot of people out of work very quickly, and that's real social disruption if that sort of comes about. So in terms of it's not an imminent threat, but if it's 3 years away, or if it's 5 years away, or if it's 10 years away, it's going to be really important to how you're doing your investments. And so, that's one of the key factors I'll be looking to look at. But and then what are governments doing to try and ease that? Are they going to make are we going to try and, is it higher taxes on rich? Is it more, or are we just going to let people funnel off corporate taxes through the Bahamas and Ireland and low tax jurisdictions? Because if that's what we're going to allow, then there's more inequality and more of these issues, and that's how we need to be investing for that type of environment.
Absolutely, yes. So certainly at the moment, the foundations are not being laid for a more prosperous and more socially justifiable future. It seems to me that the inequality is going to continue, that the role of government will probably continue to be enhanced rather than not, because they're sort of putting their fingers in more and more pies and starting to make bets now on some of those technology things as well. So you've got to ask the question about where does the future shape? And talking about futures, let's just flip across to China briefly, because China, of course, is in a very interesting situation. In some ways, they've got some of the similar problems insofar that the growth rates that they've been used to have been falling quite considerably. The attempts to sort of kickstart the economy has been relatively unimpressive at the moment. And even after the recent session that they had where they were talking about the future, there's very little outcome in terms of further investments. Now, that's important for China, but it's also important for Australia too, because, of course, China is a big player in terms of, Australia's economic prosperity. So what's your take on what's happening in China, and how does that play into some of these discussions, and to what extent are they being hampered in terms of the new technology because some of the inability to be able to perhaps get it from the West versus create their own?
I think China illustrates my point about the inequality and inflation as well as anything, because during the pandemic, their whole focus was on how do we support companies? How do we give companies more incentive to keep hiring workers, and how do we give them keep the companies investing? And there was very little direct stimulus to consumers, and so we just did not see the inflation come up in China. And so because we didn't see that inflation come up in China, we've actually seen deflation in various parts. So China's big problem is the consumer makes up too small of a part of the Chinese economy. It's one of the, I don't know if it's a record low, but it's certainly one of the lowest that we've sort of ever seen over recent history in terms of how much the consumer makes up of the overall economy, and because so much of it's business and governments, and that's because they made a deliberate decision to repress the consumption, so they can actually invest and build a better economy for them. And that sort of I think it's called Gershicron growth model. It's sort of been done by a number of countries. It works really well in the initial stages because you have a country that hasn't had the investment, and so you squash consumption, you get the investment. I cut someone's income from 100 back to 90 in order to do the investment, but actually I get 10-15% growth, and so before within 2 or 3 years they're back over 100, and now they're growing quickly and everything's great. The problem is once you get too much of that investment, and once you've got enough investment within the economy, now you're not getting the same growth rates anymore. And usually at that stage, though, there's all these vested interests that are like crowing for you to keep going, whatever we used to do, and then you start throwing debt onto the pile. and because you're not growing, or you probably used a bit of debt earlier, but the debt you had before was fine because you're growing at 10 or 15%. So it disappears into nothing. But once you stop that growth, all of a sudden that debt becomes a burden, and that's where China's very much sitting. So they know not they know. A lot of people within China know they need to switch to more consumption. And over the weekend, they actually came out with a whole bunch of things saying they are going to focus more on the Chinese consumer and trying to get that consumption part of the economy going. That is not going to be giving them any money to do it. There's no fiscal spending for it. So there's a renewed focus on words and I guess policy, and trying to get people out to spend more money, encouraging them to take on more debt and things like that. But there's actually, you need some pretty big fiscal transfers, effectively from governments or from corporates via taxation or whatever it is method, to get more money into that consumer part. And China keeps talking about doing it, but it seems Xi has a fundamental view that if by giving money to consumers, that's a waste. Whereas if you give money to corporates, they go out and build stuff, and that will be of some benefit in the future, even if it's not that productive. Whereas giving money to consumers isn't productive. So I think China is in for a long, hard, tough time of it. Replay of Japan, probably worse because the demographics are worse. They know well. So at least a number of people are telling them what they need to do, and they probably know. At some level they do need to do that, but there is a fundamental desire not to do that, and I think there's a certain element of control as well that part of the growth, as you get bigger, is devolving control out to various parts. But I think the Chinese Communist Party, and Xi in particular, doesn't want to give up control, and if you're not going to give up control, you have to accept for lower rates of growth. And so I think there's nothing fundamental that's changed in my view. But we do see these announcements come out on a regular basis. Every 3 or 4 months, we get this announcement of something they're going to do to re-spark the property market or to re-spark the consumption sector. But they're not. It's just not enough what they're doing. And this time around was, even as I said, it was basically, we're going to focus on it. We're just not going to spend any money on it. And so, I think it's tough to see that turning around anytime soon.
Yeah, but the interesting observation is that the other thing they are doing is they are stockpiling resources, which is quite fascinating too, right?
Yeah.
So a lot of people were expecting demand to fall away, but it's actually not falling away anything like as quickly as people expected.
No, and we've been kicking that one around as well. All these empty apartments are effectively the same. Like you one of your biggest sources of steel biggest uses of steel is in high-rise buildings.
Yeah.
And it's also one of your when you've got more advanced economies that have much higher levels of recycling. That's the other source of it. And so there's a reasonable argument, Martin, that because you've built all these apartments that nobody's using, if you ever did go to war over Taiwan and you got cut off from say Chinese iron ore, you've actually stockpiled a whole bunch of these apartments that nobody's living in anyway. You just need to knock them down and take the steel out of it. So, yeah.
Well, it's interesting because, of course, in the Second World War in the UK, they took all the railings down.
Right.
And so you walk around suburbs even today where they literally chopped them off at the stone level and just took the railings away and used it for the war effort. So it's been done before.
Yeah.
Which is all interesting. So, look, as we come to the end of the story, I guess, and I'm just sort of reflecting on what we've said, I think the messages as to what's going on is don't panic, have a plan. These things happen from time to time. We're not necessarily going into a massive crisis. And I have to say that all of the grizzling from some of the commentators about the Federal Reserve needing to do an emergency rate cut of 50 basis points and another one next month was just overwrought. I'd also make the point that there are a lot of people, of course, who trade volatility and are making a lot of money on one side of the trade or the other side of the trade. So don't always necessarily buy what they say because maybe they've got another agenda in what they're saying.
Well, and can I just highlight as well, copper in particular, but there's a number of other metals out there that the Wall Street banks it's a pump and dump scheme. It seems like to me is they come out with this story, and copper is one of the is a great one for it. Is it's got a relatively small use in electricity as a total. If you double, they talk about how electric vehicles and all these things are going to double and triple the amount of copper needed in that sector, and they're absolutely right. It means that for the next 20 years, you're going to need to grow copper production by about 1%. To meet demand. It's nothing. But we've been through 2 cycles already where it's like this whole pump up of this copper is the greatest thing. It's going to protect you from inflation, and then it crashes. And then when the Wall Street banks once they've piled everyone in, and they wait a year or two, and then they go run out exactly the same story again over the last 6 months. And now it's coming back off again. I've got no doubt in another year and a half they'll be back out pushing that same story, and that's a much better outcome for if you're an investment bank to have people buying in and then selling out, and then buying in and then selling out, and then buying in and selling out, then there's this price that just goes sideways for 3 years. So they're there to make money from turnover. And so
yes.
When they're selling you a story, and particularly if you're a retail investor and you're getting investment banking research, you're probably if you're seeing it getting through the media, you're one of the last people to see this. But that's there are some rules around delivery and how it's meant to go out to everyone. But you can rest assured the biggest investors are getting at least some sort of insight from conversations and all these things like that about when they should be doing these things. If you're getting that research, unless you really know how close you are to the front, you're probably one of the last people, and you're probably one of the people who they're like, I've got my big clients in there, and now the price has run up. Now I need to get my big clients out, so I need more people to come into this trade so that I can get them out. And when you see them talking heads on CNBC and Bloomberg and all that tough stuff, talking about whatever the latest story is, it's usually because they've got lots of it and they need somebody to buy the other side of it. So.
Absolutely. And in fact, IA makes the point here. There are different types of research. There's bad research and there's good research. But what I would say is, as Dan Drover says, there's a bit of pump and dump going on here as well, because by the time it's in the media, a lot of the opportunity will have passed, and then it's on to the next one. The money-making machine and the intent of a lot of talking heads around the place to talk their own book and basically protect their own position is pretty strong. And I always come back to this. Even if you look at ordinary investors trying to buy and sell, a lot of the big trades are never actually shown in the sorts of prices that you see as an ordinary investor because of the dark pools and those sorts of things. So even when you come to trading, quite often you are actually not getting the best prices simply because of the way that the markets are structured, and it means that there are a lot of big trades that go under the water, as it were.
Well, and how many times you would see people that often say that, hey, whatever, Microsoft just reported its earnings, after market closed or whatever, and it's up, 5% in aftermarket trading, and you're like, aftermarket trading? If you're a retail investor, you're saying aftermarket trading, just a minute. So it's up 5%, but I'm not allowed to buy it. Everyone else, there's other people out there trading it, but I'm off thing. And that's the idea, though. It's well worth repeating back to that. There's some that say that there's no such thing as a bad asset. There's only a bad price, and that's that key part about it. I've got this chart to show Martin, which is the Cisco earnings over the last 20 years. And you look at those, and they're great. It's so the idea is that whole Cisco thing is, the idea is, am I buying a company that's good? And you look at that, and, it was in 1999, it was earning 50 cents a share, and now it's earning $4. It's increased its earnings by sort of eight times over that time period. But then you look at the share price, and if you had it bought at the peak, you're down almost 50% on your on what you bought it at. And it's the idea that you can overpay for a good story. And so, there's the fundamentals are important. Yes, you need to have the right fundamentals, but then you're like, okay, but at what price is do I still buy? Because and that's where most of the time, that's where they'll get you, is that you've got a great story that look at all these fundamentals, look at this growth, look at all this stuff like that, and it's the price, so that's the wrong price. So, that's where you sort of need to come back.
Absolutely. And that's the whole point, isn't it? That, price is determinative of what you should do, right? Just because it's a great asset, it's not a great asset at any price.
Yes.
And that's really the question.
Yeah, and the idea though as well for people who, particularly who are getting out of risk assets at the moment, is saying, well, just a minute, a week and a half ago when they were 10% higher, you liked them, and now you don't like them, or vice versa. It's the ones when you go, you buy something and it goes up by 20%, and now you go, oh, it's great. Now I've got to go out and buy more. And it's that idea of, well, if the price is the only thing that's changed, well, no, you should be selling. You should be selling into it because it's, if the fundamentals haven't changed, if the fundamentals have changed, there might be a reason for it. But yeah, if the fundamentals haven't changed, you should be having less. And so, so that's that whole part about that rebalancing idea. And I guess I'll probably leave people with that idea that, look, if we are going into a tech boom, and another one, or, it's still headed up, is that the way to play booms, if you think they're coming, or bubbles, is you invest early and then you start taking the money off the table. You don't keep chasing it, because the people who come undone are the ones who go, I put down $1 and I double it to $2. Now I put down $10 and I lose 30%, and I'm back to 7. But I've lost all the money I made at the start. I doubled my money or tripled my money, but I've lost it all because then I doubled down or tripled down, or up 10 times. So put your money down at the start, wind it back out as it gets bigger, and then
which sort of underscores the need for active management and somebody looking at it on an ongoing basis, which of course is precisely what Nucleus through its various platforms offers, right? And yes. Just to underscore, the reason we're having this conversation is because I fundamentally believe that Nucleus Wealth's philosophies and what the Wealth Fund's philosophies are right in terms of actually making those investment decisions, taking account of all the distraction of traders, all of the distraction of the noise versus the signal. Because if you're an investor, a retail investor, this ain't easy. It's not easy to be able to actually be across the portfolios and make the right decisions. But also, of course, depending on the amount of control you want, and again, the platforms allow a significant variation from look after it all for me through to give me active management. So that's one of the reasons why it's so important.
And the I guess the thing we find with a lot of investors, particularly people who I guess are nervous about the state of the world, the state of the economy, and we've spent a lot of time bashing various elements of politicians and policies and all these things that are going wrong. But over the longer term, these markets are going up, and if you're getting that underlying growth in companies and they're earning, straight away they're earning a 5 or a 10% yield in terms of earnings growth, in terms of the earnings versus the price you're paying for it, and then those earnings are growing, is that the stock market does provide over a longer period of time, a good return. And so if you're it's a question about there's never going to be a right time to invest, but if you're at zero now, because you're waiting for a pullback, well, how much more of a pullback do you need? Do you need it to come all the way down? If so, you might be waiting for 5 years. You might be waiting for 10 years. You need to be happy with that sort of concept. And particularly if you're saying, well, if it does go into an AI bubble, am I willing to just sit in cash the whole time, and then when it crashes, I can tell everyone what it is, or do you think there's actually an element of saying, well, the long term is made up of a lot of short terms, and so maybe I should have some invested in case I'm wrong. And if that's that's where I'd sort of be pushing people to say, have some element invested. There's no asset that's so great you should have 100% of your money in it, and cash is one of those that is not so great you should have 100% of your money in it. And if interest rates do come back, if we do go through some of those scenarios, then you can sort of sit there and go, well, yeah, I'm earning 4% in the bank or 5% in the bank. But if that turns back into 1 or 2%, you might have missed the opportunity to be in other assets that are going to generate the returns. Absolutely.
And, to underscore that, markets and prices tend to go up and to the right over time. And, if you've been in the market for a relatively long period of time, you benefit from those moves, even if there are wobbles up and wobbles down. But the point is, when you get a wobble down, that's almost the last point to say, now I should sell, right? It's almost always the wrong signal, but you need a strategy. And that, of course, is what we've been perhaps highlighting a little bit today through this conversation. Damien, I want to say thank you so much for your time, as always. Greatly appreciated. We'll do it all again, hopefully next month. And there'll be more to talk about then, of course.
Hopefully it's not quite as exciting as this month. But,
well, I just
anyway.
reflect on the fact that over the last few years, it's been September and October that have been actually the most wobbly months of the year. And that's because, of course, everyone was aware with the summer. And so it's the juniors trading rather than the seniors. So I don't know. We will see. So anyway, thank you.
May go away is the US statement. But yes, so that's
exactly.
I don't know. I think actually, if you sold in May, you actually wouldn't have done that well this time because you missed all the upside.
You missed out the big upside. So thank you very much. Really appreciate it, and I'll look forward to picking up the conversation in a month's time. I'm going to take you off stream now and just close the show. Thank you very much, Damien. See you later. There you go. I hope you enjoyed that, folks. I hope we covered some of the critical issues, and look forward to having the conversation with him next month too. Just to say that next week it's going to be Leith Van Onsselen's coming on. We're going to talk about the latest in the Australian economy specifically, and some of the work that he's been doing recently. So join us for that. Should be fun. And the dogs, guess what? The dogs are actually still in their position. So there you go. They've been there pretty much all the afternoon and evening. So all pretty good. So thank you very much. Look forward to the next live show next Tuesday, and check out the recorded shows meantime. Have a good evening, and we'll see you next time. This is Martin North from Digital Finance Analytics signing off. Take care.